Welcome to Money Matters. It's Friday, the 1st of August, and lots to talk about. So in macro terms, we're going to cover the Fed's latest actions. We're going to talk around the issue of what's happened to the copper market and some of the potential side effects of the tariff deadline that's due at the end of the day today. In terms of company earnings, we've had, if we include Meta, Amazon, Microsoft, and Apple, and we add Google in there, we're going to be discussing almost 12% of the world's market capitalization. So a huge week for earnings this week and some substantial stock price movements as well. And our thought for the day, not surprisingly, is going to consolidate the thoughts around what's happening in the cloud storage market and who comes out the winner. So let's jump into the macro scene first and foremost. The Fed had their meeting on Wednesday and no changes as expected in interest rates. The market is expecting that rates will continue to stay on hold. Probability is that we're on for 2 rate cuts for this year, but now looks like at least one of those is drifting into 2026. The Fed is still talking about inflationary pressures due to the tariff. But I think that the Fed will be very keen to see how unemployment progresses between now and year end and those inflationary pressures if they were to come. Let's move on to copper. Oh my goodness. Prices of commodities are not supposed to move 20 to 25% in a matter of a few sessions. That's exactly what copper's done. So let's dig deeper into what's happened here. Trump announced that he was going to impose a 50% tariff on imported copper. The issue has been that traders have been transferring or buying in the US copper contracts ahead of the tariff imposition as of the end of today, with a view that they are now got cheap copper sitting in US warehouses to then sell on once that tariff imposition has been set. Unfortunately, they've been slightly jiggered because in the same discussion this week around the copper tariffs, Trump announced that in fact what they're going to do is they're going to impose tariffs on all copper products except refined. Now, refined is the kind of copper that gets traded. And so what essentially has meant that it's happened is that if there is no imposition of this tariff on the refined product, then what was the point of storing all this copper in the US warehouses? Hence the collapse in copper prices in the US versus copper traded on the London Metal Exchange. It all sounds a little bit complicated. The long and short of it is that the copper markets should start to stabilize until those inventories of refined copper in the US start to decline. And then we'll start to see those copper prices move back up again towards and incorporating those tariff costs. And so the immediate inflationary pressure is probably not going to come through for quite a few months yet to come. So that's the copper story and why we've seen so much dislocation in this marketplace in the last few days. Lots of people talking about this final day deadline for tariffs in the US. I just want to look at it a slightly different way and think about potential side effects of what happens to different locations and different economic environments from the imposition of these tariffs. So if and when the China tariff negotiations come to some kind of conclusion, it appears quite likely that Chinese product will start to increase in direction towards the European Union. The impact of that, given that the European Union does not tariff Chinese goods, will mean that relatively cheap product starts to flow into the European Union. And that implies that the inflationary pressures on the European Union are likely to be diminished, certainly versus the US. That would put more onus on the ECB to be able to reduce interest rates in the European Union. That then puts pressure on the US to follow suit. Otherwise, interest rates in the US would look completely out of line with what's going on at the rest of the developed economies. And if that were to happen, there is a potential that despite the long-term wish by this current administration to see a weaker dollar to encourage more exports, that actually the opposite occurs. Because if there's a big differential between US interest rates and European interest rates, we might start to see some flow back into the US dollar. We've seen it in the last few days. Don't know if there's a reason for it. It's not unsurprising to me to see that the US dollar over a short period of time could actually accelerate in a positive direction. That means that for sterling, we reached a high of some 135 against the US dollar about 10 days ago. We're already down at 132, and we could well retest the 130 level in the next week or so. So that's the macro scene. Let's turn to these earnings and take each one at a time. Let's go for Microsoft. The overall theme from Microsoft, Amazon, and from Meta is cloud and the AI opportunity and capex spend. That has been the, if you like, common denominator when discussing these companies in their recent earnings announcements. So in the case of Microsoft, we saw blowout numbers, 18% increase in overall revenues, 45% operating margins. Azure revenues were up 39% year on year. That is the fastest growing of all of the different cloud storage companies and were duly rewarded post-market. There is really nothing that one can decry in these numbers, and they've now upped their AI and cloud storage capex to $120 billion over the next fiscal year. Sales are growing at 15%, according to consensus forecasts over the next 3 to 4 years, each year, and EBITDA margin heading towards 60%. This growth business is going to stay this way for some years to come, and we'll come back to this element on Thought of the Day, because AI and the spend that's going into storage is a game changer. Meta is a different exercise. Meta showed some incredibly interesting numbers across every part of their business. They have shown growth. We've seen higher guidance, which is very impressive. The stock was up 12% post-market. Daily active users are still on the rise. They had 6.5% increase year on year. Average revenue per person is still growing. Average impressions up 11% versus consensus expectations of just under 6%. And all of this is coming from their optimization engine, which is using AI to better target advertising. Now, we know from the 1920s, John Wanamaker said that wonderful quote, which was, "Half the money I spend on advertising is wasted. I just don't know which half." Meta is changing that. Meta optimization tools are able to better direct the right advertising to the right audience. And that is a huge return on investment on their AI spend. They are spending some $17-18 billion a quarter. So on capex, again, going into this engine. And this is a very practical example of how you can accelerate your revenue stream, increase your market share, and create stickiness amongst the advertising fraternity. Let's turn to Amazon. Amazon were disappointing to some extent because their guidance was lower. Their capex, again, similar to Microsoft, is running at $120 billion over the next year. And considering that in 2024, total storage in capex was $250 billion, just between Amazon and Microsoft, you've already seen that number in place. Meta's spend is about 70 billion overall year on year, and Google similar. Now, this for me, the disappointment is that the growth at AWS that is not as significant as that at Microsoft, which, as we said, was 39% year on year. At Google, it was 32%. But I think we forget two key points here. On the one hand, AWS has a much higher market share than 33% of storage, than Azure, which is Microsoft's cloud storage platform, which is at 32%. And Google is at 7 or 8%. So in terms of the dollar increase in the businesses year on year, it was actually pretty similar between Azure and AWS. Also, something that came out from the conference call that Amazon put together was that there was a back-end block in terms of the amount of capacity that Amazon was able to put in place. So they'd actually would have seen near a 25% increase in their revenues if they were able to deploy those servers into the server farms they were already looking to allocate to. So that growth rate is stunted, but stunted for a reason. And so I suspect that over the next quarter, we'll see that growth coming back to AWS. There is nothing fundamentally different between what AWS is doing and what Microsoft and Google are doing in terms of the cloud storage market. Apple surprised on the upside. Unit growth in smartphones was up 13%, as was the services. That's pretty impressive, particularly on iPhone unit growth. The assumption was that it wasn't going to grow. China, which was negative, has actually come through the 4% growth thanks to low-end subsidies for units. And so a surprisingly good set of numbers from Apple. I still contend that the recycling of your phones is extending in terms of time. It's pushing further up towards 4 years. And I think that ultimately starts to put pressure on Apple to continue to grow its margins. Clearly in services, that's not the case. Services is going to carry on growing. Services is going to have a much better margin. Think of all these Mag 7s, Apple's probably the least likely to show the sort of growth rates that the other Mag 7 companies are able to do, particularly the likes of Microsoft, Meta, Google, Amazon a little bit behind that, and then Apple behind that. So let's now turn to thought of the day, and it's around combining the thoughts that have come through from this week in the cloud storage market. The global market is set to be some $2 trillion by 2032, growing at 20% per annum. I'm taking a slightly different perspective here. Today, Amazon, Google, and Microsoft are going to dominate, already dominate, and will continue to dominate the space. Between them, they have 70% market share. The other 30% is really split between the likes of Alibaba in China, so very China specific, doesn't include the rest of the world. So when it comes to the rest of the world outside of China, it's really about these three players. They're not going away. The amount of dollars spent on these server farms is immense. In fact, they spend 1% of total energy usage in the world today just on their server farms. Almost one medium-sized country's spend on energy. AWS is a big market share leader, followed by Azure from Microsoft and Google Cloud from Alphabet. For me, this is about creating more compute power. More compute power allows for more data learning to take place. That starts to lead towards the next generation of AI, which is around inference, where Meta already mentioned this week that their platform is teaching itself. This is inference. This is the next stage. This is the ability of AI to better itself without any human intervention. So it's a very sticky place for those vendors' clients. And I think that that's actually the end game here. Over the next 5 to 10 years, the data flows that are going to be generated through those cloud storage and server markets and data storage market hubs is going to allow for AWS, Azure, and Google Cloud to really stay with their clients and offer their clients more and more higher value added product and services that keeps them completely ensnared within each one of those platforms. There is nobody else that's going to play in this market. All of the corporates are going to be with these folks, and we're still only 20 to 30% penetrated into the cloud market. There are so many more corporates to go after. So if we step back, whether it's 25% growth versus the 17 expected, etc., all that is irrelevant. The reality is over the next 5 to 10 years, those cloud players are going to have a triopoly in place. Nobody's going to really detract from what they've been doing. They will drive compute power in the AI space. They will retain those customers, and they will then start to take advantage of that triopoly position and begin to increase price. That's where I think the real opportunity is. And again, all of these names I've mentioned, absolute structural growth opportunities, and we would stick with those for the long term. More to come next week. We wish you a great weekend. Have fun. Enjoy the weather if you can, and we'll see you next.